Thanks for joining us today. My name is Nathan Box. I'm joined here with Bryce Sowich, and we are here to unleash your 401k's full potential. And we know that saving for retirement, understanding your options, and what you should do can feel complicated, but the truth is it doesn't have to be, and we're hoping to change that. Today we're going to cover the basics of how you can make the most of your retirement plan and to help you become successful retirement savers. Now, for some of you, this is going to be a refresher, but for others, this may be the first time you're hearing some of this. But first, a little bit about us. For Pitt Capital Group, we boast in-house investment management decisions using a fiduciary approach. We have a boutique feel, so clients work with small, dedicated advisory teams that take a personalized approach to financial planning, wealth management, business consultation, and 401k management. We have exceptional client service and holistic financial advising, all while being as transparent as we can be. A little bit about me, the Director of Retirement Plan Services here at Fort Pitt. I work with businesses to help them better run their retirement plan so they can focus on managing their business, and we work with participants to help them achieve their financial goals.
My name is Bryce Sowich. Great to be with everybody. I'm Director of Qualified Plans at IFAM Capital, a sister company of Fort Pitt Capital. Worked in the 401k industry now for 30 years, working with hundreds of plans, thousands of participants, and very happy to be with you today.
Thanks, Bryce. So first, some housekeeping items. How to interact with us. If you are on a mobile device, or a phone or tablet, if you click that little Q&A at the bottom there, you can throw some questions at us and we'll get them at the end. If you are on a computer, there's a Q&A down there in the middle, and it'll pop up screen, and we'll be able to see them. And we'll get them towards the end. All right. So again, what are we going to talk about here today? Our goal here is to give you the tools to succeed and make good decisions about your financial lives. And we're going to try to break down all the financial jargon into plain English. And why is this important? 401ks are powerful tools that allow you to build wealth over time. And for most folks, this is the largest asset that people have outside of their home. So what are we going to cover? We're going to talk about how 401ks work, traditional contributions versus Roth contributions. Talk about the different investment options that you often find within a retirement plan. We're going to talk about mistakes that people often make along their retirement savings journey. And then we'll end with how you can turbocharge your savings. So Bryce is going to get us going here.
Yeah, great. Yeah, what is a 401k? How does it work? 401ks are one of the most powerful tools you can use to save for retirement. There's a couple financial benefits that come with 401ks. The first is it's an employer-sponsored retirement savings plan. So your contributions are going into the plan automatically, no matter if the market's up, if the market's down, the market's sideways. It goes in automatically before it passes through your hands. If you're like most people, if it passes through your hands and you have to make a decision about whether to save or not, it makes it that much harder to go ahead and save. The second is the tax advantage. Money is sheltered from taxes while it grows. We'll talk a little bit more a little later about the different tax treatments that we can use within the 401k plan. There's two different methods that you can use. And then the power of compounding. And really this applies to any savings vehicle, any type of investment vehicle. The longer you save, if you have time on your side, and you've probably all seen the charts, if you start saving early, your money over time is making money on the earnings. And that's really what you want to do. The power of compounding is a very powerful tool. And to take full advantage of that, we need to start saving early. So two different ways that you can put money into the plan. And really, this is kind of a personal decision, right? There's some rules of thumb out there on what you should do, whether traditional, which means before taxes, or Roth, which means after taxes. But really, most people should probably have both of these. Now, I would say if you're in a retirement plan today and you're getting a match, or if you're getting a profit share contribution, and you're contributing Roth, you probably have both of these. In most instances, that company contribution is going in the pre-tax method. In some cases now, it can go in Roth. But generally what we think of when we think of traditional versus Roth, the younger you are, the lower your current tax rate is, the more you should be putting into Roth. You should pay your taxes today. As the money sits in the plan, it goes in after taxes, it grows tax-free. And when you retire within the Roth dollars, you're going to take that money out tax-free. So it's a great way to diversify your tax treatment in retirement. Now let's contrast that a little bit with traditional 401k. And probably 3/4 of the money that's in 401ks, maybe a little bit more, is in pre-tax dollars. So money goes in before it's taxed, it grows tax deferred, and you take it out in retirement and you're taxed at that time at your tax rate. So a couple unknowns, a couple things that we typically don't know for sure. We don't know how long we'll be working. We don't know what tax rates will be, and we don't know what the market will do exactly in those time frames. So if we knew those three things, we could tell you exactly what to do. But I would encourage you to look at both of these, consider both. When you're in retirement, you can diversify your tax treatment of your dollars. For example, when you are retired and you have a pool of money, you can pull money out of the traditional pre-tax method. You'll be taxed on it at your rate for that year. And then before you go up tax brackets, you can start taking Roth money out. So as I said, it's a very personal decision. There's a lot of calculators out there that you can use, but I would ask you to consider saving in both methods so you do have a good balance in both of them. And typically, when we look at these and when we want to do some financial planning, some income planning, what we do ask you to do is make sure, if you're just starting to save the Roth method, for example, make sure that you can make it a meaningful balance in relation to your traditional dollars. We want it to be meaningful. We want you to be able to have the ability to pull that money out and control your tax rate in retirement. So Roth versus traditional simply comes down to, do you want to pay taxes today, let that money grow tax-free, or would you rather defer that income and pay your taxes at a later date? Don't miss the free money, your employer match. And I really want to emphasize this. When we're talking to people that are in retirement plans, of course, we want people to be able to max out the plan if at all possible. But if you're not maxing out your employer match, you're leaving money on the table. One of the most common examples today of what a match looks like, if you put in 6%, for example, your company will match that at 50%. Now, there's not a market out there, an investment market out there, that's going to guarantee you a 50% return in that first year. I would encourage you to please take full advantage of that employer match. It really turbocharges your savings plan. It really is a huge benefit to you. Your employer is implementing these types of matches as part of your compensation. So leaving those dollars on the table could cost you. Now, there is something called a vesting schedule that is attached to some matches. So this is something that you should check on. Vesting is simply ownership of those dollars, and it starts from your date of hire. So the longest we normally see is about 6 years. The shortest I've seen is 1 year. Or if you have something called a safe harbor match, you won't have a vesting schedule, probably, that's attached to those dollars. So as an example, if your vesting schedule is 6 years and you're there for 3, you're 50% vested in the company dollars. You're 100% vested in your dollars at all times, but this is only applying to the employer contribution to the plan. So you want to be sure that if you're thinking of leaving a company, you're thinking about changing jobs, things like that, just have it a part of the conversation of how vested are you, because you may leave some of those dollars behind that came into your account from the employer if you haven't been there long enough. And just to reiterate, it's not from when you start contributing to the plan, it's from your employment date. So if you've already been there 6 years, or if the vesting schedule is 3 years, you've already been there 3 years, if you leave, you'll get to take all of those dollars that the employer put in for you at that time. And then decoding your investments. Really, when we look at 401k plans, we go through a process, a couple steps for decision making. How much do I want to save? We talked a little bit about that. If you can maximize it, go ahead. At least, if possible, max out that company match. So if it's 50% of the first six that goes in, go ahead and put in 6% if you at all can do that. And then really, once the money's in the plan, or putting money in the plan, we have to decide from a tax treatment, how does it go in, traditional versus Roth. But then when the money's in the plan, we have to decide, how do we invest it? And honestly, this is probably the most intimidating decision for most employees, is how do I invest that money? There's a lot of noise out there at any one time. You can be driving home from work, listening to the radio. Somebody's telling you, sell now. There's too much uncertainty out there. Other people are saying there's great opportunity. Make sure you invest now. The great thing about having a long time frame, and we'll talk a little bit about this, is you don't have to listen to that noise. The way to build wealth over time is being consistent. That's not just consistent with putting the money in, but being consistent in being invested. If you are invested in the program, there are going to be different tools you can use to help you. We'll talk about those. But generally, what we look at is your time frame and your personality when deciding how aggressive to be. The younger you are, the more time you have until retirement, the more risk you can take on. And the reason is the market is volatile in the short run. The market is really consistent over the long run. If we look back over history, there's not a 10-year period in the market that's been negative, for example. So if we have one of those years, and we will have those years where the market's down 20, 30, sometimes 40%, if you are aggressive and you don't have a lot of time to recover from that, it can damage your retirement savings. However, if you have 30 or 40 years, you want to be as aggressive as you can personally handle. And the reason is you're going to make more money over time. So it's really a balancing of your personality and your time frame. And we want to take those things into consideration when deciding how to invest the money. And there are some great tools that you can use that you really just invest in them. They change for you over time. You don't have to do a thing. They're invested, they get more conservative as you get closer to retirement. So as we talk about those, I would listen pretty closely to that piece of it, because it's probably one of the best innovations that we've seen in the investment world over the last 20 years or so. Okay, navigating your 401k investment options. I mentioned there are tools that will do this for you. Generally, you can do a couple things in the 401k plan. You can choose to be a saver. That just means you're putting money in. It's sitting in a money market or something like a savings account. You can invest the money yourself. You can choose which funds you're going to use. If you do that, you have to make sure you review your account over time to make sure you're not being too conservative early on or too aggressive later on. However, if you don't want to do that, there is a very easy version that's becoming very popular. About 80% of 401k dollars that is contributed today are going into target date funds. And what a target date fund is, not only is it easy, it says the easy button here, but they're very effective. What data shows us is the average investor that invests the money themselves in the 401k plan earns about a 4% return per year. 4%. The market gives us about 10. The difference between those two numbers is strictly behavior. So target date funds are very easy. Maybe the best benefit to them is they take out some of the emotional aspects of investment decision making. For example, when we first learned about COVID and the economy was starting to shut down in March of 2020, what we saw was the most volatile month in stock market history. We went from a bull market, which is good, to a bear market, which is not, in about 16 days. Now, what's interesting about that time period is if you would have stayed invested, you were back to even 3 months later. That is absolutely crucial to understand. Now, target date investors, 99% of them stayed invested. The reason is there's like an emotional switch that goes off. You understand it's being invested for you. In human nature directs us to want to do something in the face of news like that. So when something happens, our natural inclination is to react and to do something. We feel like we have control if we do that. If you didn't react to that, you were back to even within 3 months, and the market went up tremendously from there. The most latest example was in April during the tariff announcements. Market was down very sharply. We were back to even much, much quicker than 3 months. In fact, the market's up quite a bit already this year. So target date funds are great for a lot of reasons. But the final thing I'll say about them is as time goes on, they automatically get more conservative for you. They start to protect your money. So if you are in a fund and they just coincide with the date that you plan on retiring. So if you're going to retire this year, for example, you'd be in the retirement fund or the 2025 fund. Next year, the 2025 fund will convert to the retirement fund in a lot of these series. If you have a lot of time until retirement, I think the furthest date out I've seen so far is 2070, something like that, Nathan. So 2070 seems like a long time from now, and it is. That will be invested almost 100% in stocks. Obviously, more risk involved in that in the short run, obviously more volatile. But for every date that goes by, every five, typically these are in 5-year increments, they will automatically start to shift money from stocks and closer and more into bonds, more into cash. You'll really see a change once you're about 10 years or so until retirement, kind of that time period where you don't want those big dips in the market. So if you have these available, I would really encourage you to go ahead and consider them. I've encouraged people that are in the investment business. I don't think that anybody really should be managing their own money because nobody's really immune to that emotional response. So either have somebody do it for you, give you advice, follow their advice, or go ahead and use a target date fund. From there, the individual funds, and these may be in the target date fund also. So target date fund is just a combination of maybe 15 to 25 different funds. Some invest in international stocks, some in US, some in large, some in small. But there's really two different types of management style. The first one is called active management. So you have a person or a team that is deciding what stocks to buy and sell or bonds and when to do it. So they're making decisions on what should be in the portfolio. Typically, you pay more for that. Well, always you pay more for that. The alternative to that is you can use an index fund. And an index fund is simply a basket of stocks that nobody's really making decisions about. And the biggest index fund out there is the S&P 500. What the S&P 500 is the largest 500 stocks in the US. It simply owns the largest 500 stocks in the US. We're not paying somebody to decide, do I buy Apple today? Do I sell Apple? Do I buy Microsoft? Those types of things. So index funds are great ways to reduce the cost within your 401k plan and even your personal investments. The expense ratios on these, the cost of owning these is a small fraction of what active funds are. And then we move on to stock funds. We're going to have stock funds. They're going to be in different categories. For example, large cap growth is probably one of the most popular categories today. It's the biggest component right now of the S&P 500. But stock funds are simply buying ownership in companies. They can be international stocks. They can be US stocks. They can be large stocks, small stocks. From there, we go on to bond funds. Bond funds are simply buying debt. So you're buying debt of companies or governments, and it's much less volatile than a stock fund would be, but you're going to get less return over the long run. And then the last vehicle, and I would say probably use this sparingly in your 401k plan, especially if you have a long time until retirement, is money market funds. And money market funds really are just a savings account. So think of your savings account at the bank. They're going to pay you some type of interest on those funds. Now, we're in a really interesting time because for one of the very few times in history, money market rates are actually above the inflation rate. Typically, they're not. And if the inflation rate is higher than what you're earning on your money in a money market fund, and this is why I say use it sparingly, you're guaranteed to lose money. right? Because you're losing spending power. So if the money market's paying you 3%, inflation is 4%, you're losing 1% of spending power every year. So in a 401k plan, we want to use that for short-term things. Maybe you transferred money and it's going to sit there for a couple of days. Maybe you're really close to retirement and you already did your income planning and you're happy with where your balance is. Then you can go ahead and use something like a money market in the short run. But really what we want to see, and this is what target date funds do very well, we want to combine stock funds, bond funds, and money market funds. The mix of those is called your asset allocation. It is the biggest driver of your results in your 401k plan, that mix. And that mix is what you change over time to be more aggressive or more conservative.
Perfect. Thanks, Bryce. We're going to switch gears a little bit and talk about some situations that we frequently see that, hinders people's ability to achieve their goals. Now, Bryce talked about this already, but I'm going to, pound the table on this one again. And that's, not maximizing the matching contribution that your employer wants to give to you, right? It's free money. Your employer wants to give it to you. So I highly encourage everybody to contribute at least as much as your employer is willing to match you. Again, it's free money. So take it. The next mistake we see is playing it too safe. Oftentimes when we're talking to folks, they claim that they're a conservative investor and they don't want to have it. They don't want to have any risk in their portfolio. And we kind of have to talk through that and say, like, well, there's multiple types of risk when we're talking about saving for retirement. If you stay too conservative too long, the risk is that you're not going to get the results that you need to save for retirement. So it's important that your money is allocated for your goals and objectives and time horizon, what you're trying to accomplish with this money. Fees are an important thing. Be mindful of what you're paying and to whom you are paying it. When it comes to investing, don't necessarily let that be the only thing that you look at, but certainly be mindful of that. These last two kind of go together. And something that we encounter, unfortunately, too frequently is that when people change jobs, sometimes there's the tendency to just cash out the 401k. And what we say, like I'll hear from folks is like, oh, well, it was only, $5,000 and, I just cashed it in. And I say, well, that was a pretty expensive, decision that you made there because yeah, it was $5,000, but you paid $2,000 in taxes and fees. And then over the next 30 years, that $5,000 could have grown to $40,000. So really, that decision cost you $30,000. So, I'd say we call that in the industry leakage. So I'd say whenever you change jobs, it's really important for you to either roll that into your new employer or roll it into an IRA. Please resist the temptation to simply just cash it out. Because there's going to be, when you do so, not only are you paying whatever your tax rate is on that, but then there's potentially a penalty associated with it. So again, it could be a very costly decision that is going to hinder your ability to achieve your retirement goals. The next one is kind of costly mistakes is loans, right? Because this can potentially derail your savings and that borrowing from your 401k. And I always like to say to folks, use your 401k as lender of last resort, right? And here's why. When you borrow money from your 401k and you take those funds out, those funds are no longer invested and working for you, right? So you're missing out on that potential growth that comes from those dollars as if they were still invested, right? So there's that opportunity cost that you're missing out on. There's a sneaky hidden double taxation here too, in that yes, you're paying yourself back the principal and interest, but you're doing so with after-tax dollars. So those loan payments are, kind of at the bottom of your payroll stack. After you pay taxes, it goes in. So then those loan repayments that go into your account to pay off the loan that you took get taxed again when you go to withdraw the funds. So those dollars that you took out as a loan and repaid yourself back get taxed twice, when you make the payment and then when you go to withdraw the funds in retirement. So there's a kind of a sneaky double taxation there. And then job loss risk. What happens if you leave your job, voluntarily or not? Most plans will require you to pay back the loan in its entirety. Now, if you took out a loan, it's unlikely that you have that money available, because presumably you spent it on whatever you needed the loan for. So your employer might require you to pay that back within 60 to 90 days of leaving your job. And however, if you don't do that, and most people don't, that is considered a taxable distribution to you, right? So whatever your outstanding loan balance is, if you don't pay it back within the proper time frame, that outstanding balance is considered a distribution to you, and you will be taxed and potentially penalized on whatever that outstanding balance is. So, be cautious when thinking about taking out a loan. And then the kind of the last piece is it can really hinder your savings rate, because if you have to take out a loan for whatever reason, the tendency is that people will reduce their contributions by whatever their loan payment is, right? So not only are your funds not growing the way that they would be otherwise, but you're also now contributing less, kind of double whammy to your retirement goals. So, like, whenever you're thinking about a loan, taking out a loan, let's make sure that we've exhausted all other avenues before going down that path, because there's a lot of things that you need to consider before doing so.
Nathan, can I add one thing to the job loss thing with
Yeah,
loan?
absolutely.
And this is something most of us don't think about, but we've probably know somebody or have been part of a company that's been acquired, right? So this happens all the time. Companies acquire other companies, and we deal with this a lot because we deal with M&A quite a bit. But if you're part of a company that gets acquired and they're terminating that plan, and you're going to go work for the new company that's acquiring you, that could be just like the company ceased to exist and you have to pay back that loan, unless the acquiring company has a plan for those loans. So there are situations where you don't leave the job. You're doing the same job you've been doing, and all of a sudden your company's acquired. You're still doing the same job you were doing, but now that loan has to be paid back or it's a distribution. It's completely out of your control.
Great point, Bryce.
Yeah, thanks. So beneficiary designations. This is a great thing to talk about when you're doing any type of estate planning. Just keep in mind, beneficiary designations are the most efficient and quickest way to get money to your heirs. Now, you're not really doing this necessarily for you. You're doing it for those that are there after you. But a beneficiary is a person you designate to inherit your 401k plan when you pass away. Now, an important thing to think about, and once again, as the estate planning process kind of goes on, if you do have a will, this overrides your will. We've all seen situations working with 401k plans where somebody has a will, they have two kids, and they say 50% is going to child A, 50% is going to child B. But the 401k has only one of those children listed as the beneficiary. Guess what happens? That 401k money goes to that child first, and then whatever's left is split 50-50. Okay, so it comes out before we go to your will, and it is very efficient. Now, one of the reasons it's very efficient, you can go ahead and go to the next slide here. It bypasses probate. So without a beneficiary, your 401k assets funnel into your estate, triggering the probate process. Creditors then can make a claim against it. Now, different states do have different rules about this, and different plans are written differently within the document, whether automatically your new spouse, if you're divorced and remarried, becomes your beneficiary or not. But by law, generally your spouse is your beneficiary. And if you are married, they're your only primary beneficiary unless they're willing to sign off in front of a notary giving it to somebody else. Now, normally when we're doing this presentation in person, we get some chuckles on that piece. But let me give you some real life examples. I was working with a plan and a person that was in a 401k plan at a company, and they had gotten a divorce. And part of the divorce agreement was that this person's 401k plan would go to the children. This person remarried and then came to me and said, how do I make my children the beneficiary of the 401k plan? Didn't do it prior to getting married. Said, well, the only way to do that is to go to your new spouse and have your new spouse sign off on the 401k money going to the children. Well, that didn't go very well. It wasn't discussed in advance. That's definitely something you want to discuss in advance. Now, secondary beneficiaries can be anybody. I would just encourage you not to use or have minor children, for example, as beneficiaries. They're not going to be able to receive the money. Maybe find somebody that you trust would use the money for purposes for the children if they're minors at the time. But this is often overlooked. We've got a lot of things going on. 401k itself is not always at the top of our priority list, certainly not beneficiary designations. But whenever you change jobs, whenever you have a life change, please review your beneficiary designations. If you're leaving old 401ks out there, you don't move them when you change jobs, or if you have IRAs that are out there, you can have a lot of different beneficiary designations. So make sure that you review those. Now, an interesting side note to this is some states don't even let you, until you're a certain age, don't even let your spouse sign off to give it to somebody else. Colorado, I think, is age 25 or 27 before they allow you to actually name somebody else besides your spouse. So different states are going to handle this just a little bit differently. Different states define what an adult is a little bit differently. The age of majority is 18, some of it's 21. But this is an easy way, if you do have life changes, especially marital changes, to avoid a fight. If you could just talk about this ahead of time and make sure that your wishes are known. But it's a very, very efficient way to pass money on to your beneficiaries.
It's the cheapest will you'll get.
Yeah, absolutely. Okay, turbocharge your savings. So a couple strategies, and then I'll turn it over to Nathan, and we're getting near the end here. A couple strategies to turbocharge your savings. We mentioned a couple times, please take advantage of the company match to its fullest, if at all possible. We know this isn't always possible. So the answer to that is do it over time. Go ahead and start somewhere today. Even if you're starting at 3% or 4%, just commit to yourself that you're going to raise it 1 or 2% a year. Maybe you do it on your birthday. Maybe you do it the first of the year. Maybe you do it around the time you get raises. But if you put a reminder, we all have these great phones now. They can remind us of things, and you can have them remind you every year. Increase it 1 or 2%. It's something you probably will not feel, but you'll really thank yourself down the road. Rarely do we get to retirement, and working with people that are going into retirement, rarely do they say, I saved too much for retirement. So a great way is to auto-escalate your contributions. Now, a lot of plans have this built into their program. If they do have it, and if it takes full advantage of your match, you can let it go ahead and auto-enroll you, auto-increase you every year. If you can max out your contributions, and I know it's a lot of money, but if you can max out your contributions, go ahead and do it. Make that decision before the year starts, that this year we're going to max out the contributions. $23,500. If you're 50 years or older, you can contribute an additional $7,500. You may have seen there's some law changes. Certain employees now have to do the extra $7,500 in Roth. You'll probably know already if that applies to you or not, but you can save $31,000 a year in your 401k plan. That does not include the match or the company contribution. That is strictly your contributions. Diversify and rebalance. I can't stress this enough. I really don't care how you invest your money when you look back over time. Just be consistent with it. right? So if you want to be in the S&P 500 in a bond fund, do that. Just don't change strategies. If you want to use the target date funds, I'm a big fan of those. They give you instant diversity and they automatically rebalance for you. One thing I'll say about rebalancing is it's harder than it sounds if you're doing it yourself. And the reason it's harder than it sounds is, let's say you have a stock fund and a bond fund. Stock fund starts out at 50% of your balance. 2 years later, it's 70% of your balance. The bond fund is now 30% of your balance. What you have to do to rebalance is sell what's done well and buy what hasn't returned as much to you. So you're selling high, you're buying low. But how most people view it is, I'm selling what's actually done well and I'm buying more of what has not done as well. So rebalancing is another psychological thing that target date funds can take out of your hands and make sure that you're in a place you need to be. We do get a lot of people that are within 3 or 4 years of retirement investing the money themselves, or maybe they just bought a couple funds years and years ago and never changed it. Guess what? They're older now. They're closer to retirement. They're older now. And those investments in their portfolio that are the most aggressive have done the best. And they're a higher percentage of their portfolio than it was 20 years ago. So now they are closer to retirement at the time they should be protecting their money, and they're the most aggressive they've ever been. So rebalancing is absolutely key. You can set that on autopilot by using a target date fund.
Thanks, Bryce. So wrapping it up here, hopefully with this quick primer, you're better able to understand how your 401k works and pitfalls to avoid. So for you, action steps, what do you need to do next? I would say log into your 401k at least a couple times a year. Just check on it. See what you are contributing, right? Make sure that you are contributing enough to get all the matching dollars. Like Bryce said, if you're playing off, or if there's an in-house auto escalation feature, think about turning that on. Just increasing 1 or 2% on autopilot till you're hitting that magic 23,500 maxing out, right? Review your investment, what you're invested in periodically. It will need to change over time unless you're in one of those target date autopilot situations. But again, make sure that what you're invested in is appropriate for what you're trying to do. And control the controllables. We can't control the markets up or down. We can't control tax rates or the political environment or anything. But what we can control are the decisions that we make around our investment choices and how much we are contributing. Okay. So as retirement savers, the biggest asset that we have working in our favor is time. So let's make sure that we take those steps to make the most of it. So with that, we'll take some questions. All right, so the first one, I haven't used Roth 401k before. How would I start? Great question. You can do it one of two ways. You can log into your 401k plan and change your contribution type. So if you are making your contributions all via pre-tax, you go in to log into the portal where your 401k is, look at where your contribution amounts and type, and then you would change that or add Roth to it in addition to or supplanting your pre-tax deferrals. So you can do it on that side, and then more often than not, your employer will get notified of this change and they'll make that change on the payroll side. As a belt and suspenders kind of measure, I would also double check with your payroll, person doing payroll at your company, to make sure that they've received that. So yeah, pretty easy, a couple clicks of a button and then double check that your payroll, whoever does your payroll at your company, received it.
Nathan, let me take Walina's question here, because I think I did maybe a poor job of explaining, and as I was saying it, I was thinking I was doing a poor job. What I meant by saying make sure your Roth contributions are meaningful in relation to your overall balance. And what I mean by that is, let's say you saved $100,000 in the pre-tax bucket, and you decide couple years ago, you're going to put Roth in and you retire and you have $2,000 in Roth money. That's not going to do you a lot of good because it's not meaningful enough in relation to those pre-tax dollars to control your tax rate over time. What we like to see is maybe 30% of it, 40% of it is Roth. So if you're 3, 4, 5 years from retirement, you haven't used Roth yet, there might be other reasons to use it, but that controlling the tax rate is something that you won't be able to do unless it's a meaningful percentage of your overall savings. So that's really what I was talking about. And it kind of goes a little bit into what Megan's asking, a little bit about pre-tax versus Roth or post-tax and the benefits. I would say the biggest benefit to Roth is the longer you have, the lower tax bracket you are in today. And the better the market does, the more money you're going to have. It's going to be a very powerful tool to use. But probably one of the things that it does for you, I know it does not probably, is we don't know what tax rates will be. And we have no idea. We don't know what they'll be in 5 years. We don't know what they'll be in 15 years or 20. Most people, if you ask them, will say they think tax rates will be higher. So if you're in a low tax federal tax bracket today and you do go into Roth, that could be an advantage. You're paying at today's tax rates. So a disadvantage of pre-tax is you don't know what you're going to pay taxes at. Now, vice versa, a big advantage of pre-tax is you get the tax break today. And a lot of people, when they're saving a lot in pre-tax, it's because they're at the highest tax bracket they will be in their career. They're the high earning years. So they want that tax break today. If they put money into Roth, they're not going to get that tax rate today. They're going to pay it today. So it's really a balancing of those factors. And I made the comment that if we knew what tax rates will be, we know how long you live, and we know what the market will do, we could tell you exactly what to do, but we don't know those things. So we have to balance the two. But pre-tax is where the majority of people have most of their money. Roth can be a very powerful tool. One thing I will say about Roth is I get questions all the time. If Roth is so great, will it be taken away from us eventually? And my answer to that is if you look at recent legislation, when I say recent, I mean anywhere from a year ago to 15 years ago, is the government wants Roth. They want you to have Roth. And the reason for that is they get their tax money today. So I had an example of when we talked about catch-up of some employees having to put that in Roth. The reason that rule was changed is because the government wants the tax money today. Even though they would get more later in the pre-tax environment, they don't care about that. They want it today. So I believe we're going to see more and more Roth, maybe even required. One of the proposals was everybody is required to put in the first $7,000 Roth. That didn't pass, but it was a proposal. Another is 50% has to go in Roth. So we see these things quite a bit. I don't think we're in any danger at the moment of Roth going away because the money goes to the government right now, and they're the ones that make the rules.
The next question here is, I'm currently in a target date fund. It's my work. Perfect, reevaluated. Great, I like to see that you're maxing out your 401k and the backdoor Roth. How do you recommend people diversify investments between the 401k Roth and then separate brokerage? Well, that's where you need to look at all your different investments holistically and put them together to make sure that you are properly diversified. And that's, one of the challenges when you have multiple accounts. But, given the scenario that you just laid out here, you kind of got to keep them separate. But, I would say take a look at everything holistically, because that's what we do. And to make sure that when you add it all up, that you're where you want to be for what you're trying to accomplish. Got a question here about RMDs that you have to take in 2 years. Are you too late for Roth conversions this year and next? No. I mean, you can certainly do some conversions. Obviously, you do a Roth conversion. Conversion being, I'll explain that. where you take money that's in a pre-tax bucket, either in the IRA or within your 401k, you convert those dollars to Roth money. Now that is a taxable event in the year in which it occurs. So if I, take $5,000 of my IRA and I put it into my Roth IRA, I have now just realized $5,000 more of income. But if you do have a large RMD coming down in a couple of years, you could take a little bit off that table, that tax bite that you'll get in 2 years by converting some of it this year and next year. That's let's say, a more detailed planning question we might want to dig into. $51 and contribute to the max my 401k before tax, reduce my overall income, as well as flip and use the catch up to fund the Roth 401k. Thoughts on that approach? Make sure I understand your question. So you do the catch up as Roth, so the 7,500 that you can as a Roth, and you might be required to do so given your income levels. But I think that speaks to Bryce's larger point is, building up that Roth bucket and making sure that it's a meaningful part of your overall portfolio, given how much time you have left to save.
Yeah, and I would say you're answering Patrick's, right?
Yes.
Yeah, Patrick, I would say that's another example. Just like Nathan just said, that might be a more in-depth conversation because there's other factors that go into it. On the surface, I don't have an issue with it, but I don't know the other factors that may affect that. So that might be a follow-up where you reach out to us and then we can answer that individually for you based on those factors.
Yeah. So I think we tackled all the, oh no, one. Oof. After tax contributions to a traditional IRA, how do you figure out my pro rata tax liability? Well, hopefully you were tracking your basis as you were making those after tax contributions to your IRA. So that would be how you'd want to do it. I would also certainly engage with a CPA to help you figure that out, because it'll be something you'll need to coordinate with them come tax time. All right, we had a lot of great questions. I appreciate it. The engagement. So thanks for coming. Please stay tuned on our website for upcoming and past webinars and content on our blog. You can see it right there, forfeitcapital.com/blog. Thank you again. Here's my contact information, email and phone number. Please do call or email. You got Bryce's information here and disclosures. So thank you again. We appreciate your time.